This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
DCF techniques. Now this is the fourth session on this chapter. The previous three were all connected: NPV, internal rate of return, modified internal rate of return. This last one is in fact completely separate. As you can see on the screen, it's multi-period capital rationing, and to explain, we're going to use the little example on page 50, example 4. Now, you've heard of capital rationing before. Capital rationing simply means we've got limited cash available for investment. And if you look at example 4, it says Paris has 3 projects available for investment with the following cash flows and NPVs at a cost of capital of 10%. And without looking through all of them in detail, if you just look at Project A needs an investment of 5,000 at time 0. It needs another investment of 4,000 at time 1. Then it gives inflows, 8,000, 4,000 at times 2 and 3. And the NPV, in the exam you'd probably have to calculate, but here I've done it for you. And trust me, it's correct. The NPV at 10% is 976 positive. Now, there are 3 projects. They all give positive NPVs, and so we would like to do all 3 of them. But the problem is the cash available for investment is limited. If you look at the bottom of the question, in year 0, we've only got 14,000. Of course, to do all 3 projects, look back. A needs 5, B 8, C 6 needs more than 14,000. We can't do all 3. But equally, at time 1, year 1 is limited as well to 5,000. To do all 3 projects would take what? A takes 4, C takes 6, that's 10. B actually returns 2, so it would need a net 8. But again, we're limited. Well, we're going to assume, well, you would be told, in fact, these projects are infinitely divisible. And remember, from F9, or paper 2.4, it simply means we can do fractions of projects. So we might decide to do half of project A, 75% of project B, and so on. So we can do fractions of projects, but our job is to decide what proportion of each project should we do, up to a maximum of 100%, so as to get the maximum net present value without obviously using more cash than is available. Now, in fact, in the exam you wouldn't be expected to come up with a solution, because as you'll see it involves linear programming, but you can be expected to formulate the problem. And that's all we're going to do here. We're going to set up the problem. We're not going to solve it. And again, you wouldn't be asked to solve in the exam. However, it is a linear programming problem, so hopefully you remember the basic idea involved in linear programming. First of all, we'll define the symbols, define the variables, and what we're going to do is we're going to let A, any symbols you like, but let A equal the proportion of project A invested in so we might invest in 50% of A, we might invest in 80% of A, well, little a, 0.5, 0.8. Similarly, B, there'll be the proportion of project B invested in, and C, proportion of project C. What else? For reasons again that I'll try and make clear later, it may be that we don't use all the cash at time 0, and it does say, the very, very last line of the requirement, that any capital not used in year 0 may be put on deposit for a year and earn interest at 7%. Well, we'll discuss later why we might or why we might not do this, but if we do put any money on deposit, well, I'll let that be D. Actually, no, to avoid confusion, I'll let it be P. Let P equal the amount put on deposit at time 0. Now, if that creates any worries in your mind, be patient for a moment. I'll clear up any worries as we're going through the rest of it. Finally, of course, our job is to maximize the MPV. Well, I won't write separate symbols for it. I'll use MPV to represent the total MPV. MPV equals total NPV. Again, our job is to formulate the problem. So let's set up the constraints. First of all, time 0. At time 0, how much are we going to invest? Well, if we're investing in a proportion A of project A, surely the total investment in A will be 5,000 A, 50% of A, 80% of 5,000, and so on. In addition, we're investing in a proportion B of B, so we'll need another 8,000 times B, and similarly 6,000 times C. So there's the total that we'll need to invest. In addition, we can put money on deposit. Well, that was P, so the total we'll be using is that. And the total we'll be using, well, the total cash available is 14,000. It cannot be more. It must be less than or equal to 14,000. Now, here's where some of you may have a little question. First of all, why are we not automatically using all 14,000? Well, 2 reasons. First of all, if you forget about this deposit, ignore this deposit just for a moment. I'll put it back in a second. Although obviously you want to do as much of each project as we possibly can, don't forget we are going to be limited in time 1. So it could be that because of the limit at time 1, we're not able to do as much investment as we'd like at time 0. And therefore, we might not need all 14,000. Second question though, even if you accept we might not be able to use all 14 in the projects, if there is any left over, why doesn't it all go on deposit? You see, P might be 0, we might have none left over, but surely anything left over, why not put on deposit? The reason's quite simple. Don't forget, that 14,000, one way or another, is being borrowed. This company's borrowing money at 10% the cost of capital. They're prepared to invest it in the projects because they all give positive NPVs. But if they put money on deposit, look at the last line of the question, it's only earning 7% interest. So they'd be borrowing at 10% and only earning 7%. So clearly, they might not put it on deposit. The question then is, why would they even consider putting it on deposit? Well, even though they're going to make a loss on that money, it might be worth making a loss because it would mean there was more available next year. See what I mean? That the limit at time 1, well, remember you're investing proportions A, B and C of the 3 projects. So how much will we have to invest? 4,000 A. B gives back money, so minus 2,000 B. C needs investment, so plus 6,000 C. So there's how much the net amount needed for the projects. That must be less than or equal to the amount available. The amount available is the 5,000 we're told, plus, of course, any money that was put on deposit at time 0. Now, although it may have ended up being 0, P if we did put money on deposit, how much do we get back at time 1? It earns 7% interest, so we'd have P times 1.07. Now again, it could end up that P, if we were going to solve it, P ends up being 0. But hopefully I've explained why we might put on deposit, in which case there we are. Finally, of course, there's no point in putting any money on deposit at time 1, because we've already established any money on deposit is losing money. There was only a point at time 0 because we've got the limit at time 1, but there's no point in depositing at time 1 because we're not short of capital at time 2. There are the main constraints. Few more though. For each project, surely A, B, and C, they're the proportions in each project. Well, they must be greater than or equal to 0. We may decide to invest nothing in one of the projects, but we can't invest a negative amount. And equally, they must be less than or equal to 1. One of the requirements of infinitely divisible is that although it can be any fraction of a project, you are limited to 100% of the project. Finally, for the constraints P was the amount put on deposit. I've already said it might end up being 0, but of course it couldn't be negative. P must be greater than or equal to 0. Those are the constraints, and any solution we were to end up with, A, B, C and P must satisfy those inequalities. Finally, though, the objective is to maximize the NPV. The NPV, easy apart from one tiny little trick. The NPV from A is 976. If you've invested in a proportion A, it'll be 976A. Similarly, B, 2529B. C, 862C. So that bit, I hope, easy. However, remember, we may have made one more investment. The amount on deposit. At time 0, we'd invest P, and we'd get back a year later P together with 7% interest. Well, we knew we were going to lose money, but surely we need to work out how much. Surely the investment at time 0, we invested P. At time 1, we got back P times 1.07. And we need to work out the present value at the cost of capital. Well, P at time 0 is P. The discount factor 1 year at 10% is 0.909. And so the present value of the receipt is P times 1.07 times 0.909, which is 0.97263p. Check me, please. But the inflow, P times 1.07, P plus 7% interest. Present value multiplied by 0.909. You should end up with 0.97263p. So what's the NPV? 0.97p minus 1p. Is minus 0.02737p. It's negative, but no surprise. We knew we were making a loss on it, but the full expression for the NPV is what we've already got, 976A, etc., minus 0.02737p. And there we are. There is the problem. It's a linear programming problem, of course, but you couldn't be expected to solve it. I know at paper paper F5, in the new syllabus. Had there just been two variables, you could be expected to solve using a graph. But even that won't be asked at P4. P4 would be simply formulating, setting up the problem.